Okay, thank you, and welcome to our second lesson and our second topic. So last time we discussed about the short-term liabilities, where we said that these are liabilities which are actually settled within a period of 12 months or in the normal operating cycle. But the period for settling of the short-term liabilities should not be more than 12 months. So today I want us to look at the accounting for the long-term liabilities. So these are different from the short-term liabilities because their settlement involve more than 12 months. So we say long-term liabilities are obligations due beyond 1 year or the operating cycle, whichever is longer. That means the operating cycle in most cases for most corporates is normally 12 months. So these liabilities, they are settled in a longer period. The purpose for long-term liabilities is that they are used to finance large investments and are recorded at the present value of future payments. That is to say that if, for example, a liability will mature in 5 years' time, when you are recording it today, you record at that particular price. So whatever you could have paid in 5 years, you record that amount today. Examples of long-term liabilities includes both payables, long-term notes, leases, and mortgages. So let us look at some of the long-term liabilities, and we are going to start with the bond payable. So the bond payable are a long-term debt instrument issued by a company or government to raise capital. That means the sole objective of issuing a bond is actually to raise the capital. And I'm very sure most of us, if not all of us, you have ever heard of Euro bonds. So this was a bond issued by the Kenyan government to the European nation so that the European nation can give us funds, or the Kenyan government can be able to raise some funds. And most of these funds, they are normally for the infrastructure development, like doing roads, railways, etc. So when a company issues a bond, it is essentially borrowing money from the bondholder with a promise to repay the principal amount, that's the face value, at a future maturity date, along with periodic interest payments, which are called coupons, as we discussed last time. So for a bond, it normally attracts some interest, and this interest they are referred to as the coupon. So every month or at an agreed period, the bond issuer normally pays the bondholder the principal amount plus the periodic interest. Now, there are three ways in which a bond can be issued. A bond can be issued at par, a bond can be issued at a discount, and a bond can also be issued at premium. So let us look at how a bond can be issued at par. So we say a bond issued at par is sold at its face value, also called nominal or principal value. The coupon rate on the bond equals the prevailing market interest rate, so the investor pay exactly the amount to be repaid at maturity. So this is to say that the coupon rate or the interest rate that is on the bond is actually equal to the market interest rate. So the market interest rate is the rate which is ruling at the market. For example, if you borrow money at 10% per annum, you know, so this 10% per annum, it is the same rate that anyone else in the market will borrow that particular money for, or even if it's for the investment case, if you have invested in the bonds, so if the bond bears 10%, that's the same thing that everyone else will get. So there will be no comparative advantage between you who has maybe bought a board or anyone else in the market. A company issues a bond with a face value of $1,000, a coupon rate of 6%, and the market rate is also 6%. So the bond is sold at 1,000 each per value. So you can see in this case, it means, for example, here we have the bond issued, and the market rate is 6%, and the bond is also issued at 6%. So these two interest rates are the same. So that is what we refer to as the par value. So the amount that you borrow, you are going to pay exactly the same amount. Let me just admit a few colleague of ours here. All right. So moving on, we have both issue at premium. And now in this case, where a bond is issued at premium, we find that the coupon rate is higher than the market rate. So a bond issued at premium is sold for more than its face value. This occurs when the bond coupon rate is higher than the current market interest rate, making the bond more attractive. So the excess amount received over the face value is recorded as premium, which reduces the effective interest cost to the issuer. For example, a company issues a bond with a face value of $1,000, a coupon rate of 7%, but the market interest rate is 6%. The bond sell for 10.50. That is at premium. So you can say in this case, the market rate is 7%. I mean, the coupon rate is 7%, but the market rate is 6%. So in this case, the bond holder will be paid more with $50. If you look at the previous example, the bond holder will be paid exactly the amount that he bought the bond, so making it less attractive. But in this case, you find that the bond is more attractive because the amount of money that you buy the bond is less than the one that you are going to sell the same bond. All right. Then we have a bond at a discount. So a bond issued at a discount is sold for less than its face value. This happens when the bond coupon rate is lower than the current market rate. So for example, if the coupon rate is 5%, yeah, and the market rate is 6%, then it means here the bond is sold at a discount because the coupon rate or the rate at which the bond is issued is actually less than what the market offers. So those are the three ways in which a bond can be issued. So we have said a bond can be issued at par, where the market rate and the coupon rate are the same. The bond can also be issued at premium, where the coupon rate is higher than the market rate, and the bond can also be issued at a discount, where we have the coupon rate is lower than the market rate. So do you have any question up to that point? So we have some key concepts on the bond valuation. So the first concept is coupon interest. I'm very sure most of us, the word coupon is very new to us. So the coupon means fixed rate paid on the bond. So that amount that you are saying, the 6%, the 7%, that amount which is on the bond is what we refer to as the coupon interest rate. Then we have the coupon payments. So these are the payments that are made, and the payment can be made either annually or they can also be made semi-annually. So these payments, they are calculated in terms of the face value times the coupon rate. That's how you get the interest that is normally paid. Then we have the market interest rate or the yield to maturity, and this is the rate of return required by an investor for a similar bond in the market. So if, for example, the bond is 10,000, so the rate that you are given by the bond holder and the rate that any investor out there will get, yeah, that's what we call the market interest rate or the yield rate. Note the difference. The coupon interest rate is a fixed rate you are given by the bond holder or the bond issuer, and the market interest rate is the rate that you can get out there in the market. And we have said that the payment, the coupon payment or the interest payment, you get it by multiplying the face value times the coupon rate. So the other thing is the concept of the present value. And we say this is the current value of a single future amount of money discounted at a specific interest rate. For example, what is the present value of Kenya shillings 100,000 to be received in 3 years, discounted at 10%? So you want to know the 100,000 Kenya shillings in 3 years. What will it be worth today? Yeah. So with that, you normally calculate the the present value. So, but now we are going to look at the present value and the present value annuity, because in some cases you find that the amount, if the amount is going to be received at once, that will be the present value. But if the amount is going to be received at the end of every year, then we are going to have the annuity. So we will look at that one from a practical perspective. Allow me to admit some few students here. So then we have the concept of the present value of an annuity, and this is the current value of series of equal payments at annuity made at regular interval, discounted at specific interest rate. So the present value annuity, this one we get when the payment is made annually, and this is the formula here. Present value annuity is equals to the C represents the cash flow. That's the amount that is being paid. 1 minus the 1 minus 1 plus R. R is the interest rate, the coupon interest rate. You have that one list the power of negative n. Negative n is a number of years. So again, we are going to look at this practically. Example of a bond issued at par. On 1st January 2024, Alpha Limited issued a 4-year bond with a face value of Kenya shillings 500,000 and a coupon rate of 9% per annum, payable annually. So at the time of the issuance, the market interest rate was also 9%. So you can say in this case, the coupon rate is 9% and the market interest rate is also 9%. So they are the same. So that means if the bond issued was 500,000, yeah, the bond issued was 500,000, it means that is the same amount that the bond will be sold. Yeah, so if you are given, if you have invested, say, with the Central Bank of Kenya, and you have given them your 500,000, they are going to return to you the exact amount. That's what it is. So calculate the present value of the bond on the date of issue. So what you are being asked to do here is you are being asked to say this 500 today. How much will it be worth 4 years today? Explain why the bond is said to be issued at par. So how should we go about this? Oh, I can see somebody is saying, please share the screen. How are we going to understand? And this, can you see the screen?
No.
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 Oh, but I have gone so far, and I say that in case I lose you, let me know. And I've really gone so far. Are you see it now?
Yes.
Yeah, sorry for that. Please, it's always good that if you can't be able to see, let somebody call me on my mobile phone, because sometimes I can't be able to see the text unless maybe I come here and check on unless I go to WhatsApp or I check on the chat. Yeah, so please, because you have my number, just give me a call and tell me that you can't see, or somebody can just unmute and tell me that you can't see. Is that okay?
Okay.
Yeah.
Yes.
Yeah, because now you can see we can really do a lot of charity work. Now, I'm on this example. So on 1st January 2024, Alpha Limited issued a 4-year bond with a face value of Kenya shillings 500,000 and a coupon rate of 9% per annum, payable annually at the time of issuance. So the market interest rate was also 9%. So in this question, what you can see is that Alpha Limited issued 500,000 bond, and this bond is for 4 years. So the coupon rate, or the amount that the Alpha will be paying, will be 9% per annum, paying 9% per annum. So if you get that the amount will be paid per annum, you know that one, you know very clearly that you'll be computing the present value of annuity. Then at the time of issuance, the market interest rate was 9%. So here, the 9% is for the 9% is for the face value. Yeah, so the face value, you are going to compute the present value, and then for the coupon rate, you are going to compute the present value annuity. So we are going to see how this will be possible. Now, how are you going to go about this? So just the statistics of the question. One, we have the face value, which is Kenya shillings 500,000. Then we have the coupon rate, which is 9% per annum. So then for the coupon rate, you need to calculate the interest. How much are we going to pay as interest on annual basis? And we say the amount that we need to pay on annual basis is the coupon rate times the face value, which is for the $5,000. Then this for the $5,000, it's going to be paid. We need to see how much will be this for the $5,000. How much will be equal, in 4 years' time today. So we look at the present value annuity, and we have the rate of 9%. So we have said it's 9%. Yeah. So 9% is the coupon. So we go back to this formula here. The present value annuity for coupon. So we look at what will be the present value, of annuity. So we just replace R with 9. And if you do that, you are going to get the present value of annuity in 4 years will be 3.2. So what you do is that this 3.2, you multiply by the amount that will be paid, this 45,000. So because we're asking ourselves, how much will be 45,000 in 4 years equal to today? So you get this 45,000, you multiply by the present value annuity, which is this amount. Then we have the present value, for 500,000. So this 500,000 you multiply by the present value, which is this amount, and this 45,000 you multiply by this one. Then you add the two. When you add the two, you are going to get the market price. So this is it. So the present value or market price of the bond is equals to present value of interest payment, which is 45,000 times the present value annuity, which will give you 145,787, plus present value of the principal repayment, which will be 500,000, again times the present value. This is not annuity, which is 354. And the total present value of the bond will be equal to the present value of interest payment plus interest value of the principal payment, which will be 500,000. And there are some small differences there. But you can see the market price of the bond is almost the same with what was issued because the coupon rate and the interest rate are the same. So that is how we go about this. And the other question is why the bond is issued at par. So a bond is issued at par when the coupon rate equals the market rate, which I have demonstrated. In this case, both are 9%, meaning the bondholder is compensated fairly relative to the market. Therefore, the present value of the future cash flow equals the face value, and the bond sells at par. So, do you have a question on this one? Is it clear? Can someone unmute and say whether it is clear or not? Or do I need to repeat?
Excuse me, sir.
Mhm.
Can you please repeat because we were not seeing the Zoom before, so we are hanging somewhere somehow.
Where in particular?
Um,
So, if I may repeat, I say that the bond can be issued at par, where we have the interest rate on the bond equals the market rate. I've also said that the bond can be issued at a premium, where the coupon rate is higher than the market rate, and the bond can also be issued at a discount, where the coupon rate is lower than the market rate. So those are the three key things that you need to understand. Then we have the coupon rate, and these are the interest rate paid on the bond. The coupon payments, these are the annual or semi-annual interest payments. Then we have the market interest rates or yield to maturity, and this is the rate that is required by the investor for a similar bond in the market. Then there is the concept of the present value, which I said this is how much worth the money is in a particular period of time. For example, how much will be worth of Kenya shillings 100,000, yeah, 4 years or 3 years today. Then the annuity, so this is where the payments are made in equal payments, and these are made at the annual, or it is made annually, and you need to discount, or this amount is discounted at a specific interest rate. Yeah, then we have this example where we have on 1st January, Alpha Limited issued a 4-year bond with a face value of Kenya shillings 500,000. and a coupon rate of 9% per annum, payable annually. At the time of issuance, the market interest rate was also 9%. So in this case, the coupon rate and the market rate are the same. So you are required to, one, calculate the present value or market price of the bond on the date of issue. So what you want to know is how much will be 400. I mean, how much will be 500 be worth in 4 years, but today? That is what you want to know. And we have gone a step ahead and said that this 500,000, to get how much it will be worth, we are going to compute two things. One, we are going to compute the present value of annuity of the interest that is going to be paid annually. And the interest that is going to be paid annually, we normally get it by multiplying the coupon rate, which is 9%, you multiply by the face value, which is, that is, you get 45,000. This 45,000, you ask yourself, how much will be this 45,000 be equal in 4 years today? So this is where now you discount using the present value annuity. And I have just shown you the formula for present value annuity. So this 45,000 you multiply by the present value annuity, which will be 3.2. So to see how much this 45,000 will be, how much will it be in 4 years time today? Then you add that one to the present value annuity of the principal. So how much will be this 500,000 be worth in 4 years today? So this one you multiply by the present value. Remember, this is not annuity, it's just the present value because this 500,000 is the principal amount. So the market price is equals the present value of interest payment. Then you add the present value of the repayment. Present value of the interest payment, I have said, this is equal to the 45,000 annually for 4 years. So this 45,000 you multiply by the present value annuity, which will give you 145,000. Then there is the principal, the PV of the principal payment, which is 500,000 at the end of the 4 years, which again will be equal to 500,000 you multiply by this. Then the total present value of the board, you add the two to get the figure there. Is that clear now?
Yes.
Okay, thank you. So if it is clear, then I want us to do this. So let us try this question using the same concept and we see whether we can get it. So I'm going to give you 5 minutes to try that. So have you been able to get it? Anyone? Anyone who has been able to get something?
Yeah.
Sorry? Yeah, what? You're stuck.
Give us a moment, please.
Okay, okay, fine. So anyone who has been able to get an answer? So can we do together?
Yes.
Okay, fine. So on 1st January 2025, Bravo Limited issued a 6-year bond with a face value of Kenya shillings 800,000 and coupon rate of 11% per annum, payable annually. At the time of issue, the market rate was also 11%. So let me ask, was this bond issued at a premium, at a face value, or at a discount? And let us participate so that at least, can you see my screen? Oh, I don't know what's happening to my screen. Can you see it now? Please unmute and say because can you see it? Can you see the screen? Someone to unmute and say whether you can see my screen.
Yes, we can see now.
Okay. So I'm asking now this board, and please unmute and say because I can't be able to see the chat. Was this board issued at? I have said the board can be issued in 3 ways. One is at a premium, the other one is at par, the other one is at a discount. So how was this board issued? That's the first conversation that you should have.
I think it was issued at par.
Yeah, the board was issued at par because the coupon rate is 11% and the market rate is 11%, which is they are the same. So for you to decide the mode of the board issue, you look at the interest rates. So you can see the interest rates are the same. Now, calculate the present value of the board on the date of issue. So I want someone to unmute and tell me what's the first step that you're going to do for you to get for you to get a solution to this. What's the first thing that you need to do? I want us to do it together so that you understand.
Calculate the market price.
Creating them is so you need to calculate the market, you need to calculate the present value of the market price of the board, right? So my question is, what is the first thing you're going to do? Okay, the market price of the board is equals to what? We said it is equals to the present value of the interest that is paid and the present value of the face value. Is that true?
Yes.
Yes. So now I want us to calculate two things. Yeah. So before you even start working on this question, first of all, you need to know the formula. We say, and I think you should be noting in this down somewhere. First of all, is to get the formula that the market price of the board is equal to the present value of the interest that is going, the interest payable, and the present value of the face value. That's the first thing that you need to get. Now, the second thing that you need to get is the coupon interest payable is equal to the face value times the coupon interest rate. So can someone get that? What is the coupon payments?
88,000.
88,000. How did you get that one? How did you get that one? That's the truth. So tell us how did you go that one?
11% multiplied by 800,000.
Correct.
Yes.
That is the first thing that you need to do. Now, the second thing that you need to do, you need to get the present. You see now this board is issued at the interest is paid at, it's paid annually. The next thing you need to get is the present value annuity of 11%. So you get the present value annuity of 11% for the interest rates and present value of 11% for the face value. Okay. So can we get the present value? Can we get the present value annuity at 11%? So we said the formula is 1 minus bracket 1 plus r, close the bracket, lay to negative power of negative n, you divide by 1 plus r. That is the present value annuity. So you get the present value annuity for the interest. That one you
Can you repeat the formula?
the formula is 1 minus bracket 1 plus r close the bracket raise it to negative n, you divide it by 1 plus r. That is the formula for present value annuity, and that is the one that you are going to use for Kapuni rate. Is that okay?
Yes.
Now the second one is the present value for 11%. And the present value, the formula is 1, you divide it by 1 plus r to the power of n.
Pardon the formula, please.
The formula for present value is 1, you divide it by 1 plus r, close the bracket, leads to n, the power n. So I can go back to, so you can see the formulas. So these are the formulas, they are here. So this is one for present value, you can see it. So where you have FV, just replace it with 1. So you divide it by 1 plus R, open and close the bracket, raised to power n. And then we have the second one for present value annuity, which is 1 minus bracket 1 plus R, close the bracket, raised to the power of negative n, you divide it by R. Sorry, I think I had said 1 plus R, but it is just R. So in our question, how much is the present value annuity factor? So 1 minus 1 plus 0.11, you raise it to negative 6, close the bracket, divided by R, 0.11, 4.2. How much do you get?
0.4654.
Have you divided it by R?
Yes.
You have not. 1, it is 1, just get 1 minus 1 plus 0.11, close the bracket, raise it to the power of negative 6. Then you divide it by 0.11. How much are you going to get? How much? And please don't chat because I can't see the chat. You can only unmute so that you can communicate. How much do you get? Do you have calculators or even mobile phone? It's very simple. Just 1.
4.23.
Yes, 4.23. So can you now that is the present value annuity. So this 4.2 can you multiply by the interest? How much was the interest that was to be paid per year? We said it is 88, right? So can you multiply that answer by that? Is it 88 or 880?
Yes.
Yeah, can you multiply that? How much do you get? Did you get
372, 240.
No, it should be 372, 287. I don't know, maybe because of some decimals or anything. So it should be 372, 287.331. Now, that is 88,000. That is how much worth will be 88,000 in 6 years today. Is that okay? Now you should add this to the present value of 80,000. So what is the present value factor? So let us get the present value factor, and I hope you are recording this one. So we say this one is 1, you divide it by bracket 1 plus 0.11, close the bracket, raise it to the power of 6. How much do you get? How much? How much is 1 plus 0.011 raise it to the power of 6? How much do you get?
$1.68.
No. Just get 1 divide by, open the bracket, even if you are doing with a phone, 1 divided by 1 plus 0.11, close the bracket, raised to, not negative, raised to power of 6. 1 minus, open the bracket, 1 plus 0.11, close the bracket, raised to the power of 6. Okay, let's just get started since you can move faster, because I can see time is far much gone.
0.53.
Yes, 0.53. So no, the market rate is 10%. No, not which question are you doing? Oh, we are doing this one here. So for this question, it's the same way we have done the other one. The same way we have done the other one. Get the, yeah, it doesn't have the workings. Yeah, but just get the interest rates, the present value annuity at 11%, get the present value at 11%, and multiply the present value with 500,000, multiply by the present value annuity with 88,000, get the total, and that will be the market price. So let us look at the discount. So now for the discount, and the reason why I have decided to overstay in that particular question is because it's the same concept. The same concept. It's only now that the issue is on discount. For example, on 1st of January 2025, the Rotary Limited issued a 5-year bond with a face value of Kenya shillings 1 million and a coupon rate of 80% per annum, payable annually. At the time of issuance, the market interest rate was 10%. So in this case, you can see the coupon rate is 80% and the interest rate is 10%. So the coupon rate is lower than the market rate. So how do you get the market price? So the market price, you are going to get it by, one, the way we have just done the other one, get the coupon rate, which is 80%, yeah, multiply by 1 million to get the annual coupon or the annual interest that will be paid, which will be 80,000. Then get the present value annuity at 80%. Also get the present value at 10%. Multiply 80,000 by present value annuity at 80% and get the present value of the principal, that is 1 million multiplied by present value factor at 10%. So here it is. Payment of interest will be 80,000 multiplied by present value annuity factor. Then principal amount, again the same. Then you combine the totals. And you are going to see the amount that will be paid will be less than what was actually issued. So this is at 924, the other one was 1 million. So do you have anyone who wants to make a clarification on this before we move on to the next one? Okay, now the next one, we have now, we have a class activity here. So I will share with you this. This will be an assignment. So once you do the assignment, we are going to discuss it in our next class. Now, the board issued at a premium. Here, we have the coupon rate is 12% and the market rate is 10%. Again, we do the same. Yeah, the first step, the first step is for you to get the coupon payments, which is 900,000 multiplied by 12%. That's the first step. The second step is for you to get the present value annuity of 12%. So get present value annuity of 12%, multiply by the amount that you got from the first step to get the present value for the coupon. The third step, get the present value factor at 10%. Then multiply by 900,000 to get the present value for the face value. Then combine the two to get the issue or the market price. Is that okay? So let me know whether I'm losing you or we are all together.
You excuse me.
Yes. Yes.
Someone in the group, she's asking if we may let her in.
I've done that. Oh, there's anyone else? No, no one else. So now that is how the board are issued at premium, discount, and all that. So they are very simple concept. You just need to do some a bit of practice, and then you are good to go. Yeah. In the event that you have some challenges, you can always write on WhatsApp or any other platform. Then we can subject it to a further discussion. Now, the final concept on this one is on the analysis of long-term liabilities. So remember, we said that for the current liabilities, we analyze them in terms of the current ratios, the asset ratio. Those are the two main ratios that are used to analyze current liabilities. So for long-term liabilities, we normally use debt to equity ratio, which is equals to total long-term debt you divide by shareholders' equity, and this measures the leverage and financial risk. The second one is the interest cover, which is EBIT over interest expense, and this shows ability to meet interest payments. And the final one is debt ratio, which is total debt over total asset. We have an example here. XYZ Limited has the following financial information for the year ended 31st December 2024. Long-term debt is 800,000, current liabilities, shareholders' equity, earning before interest and taxes, interest expenses, then you have the total asset. Then you are required one, calculate debt to equity ratio, second is debt ratio, and the other one is the interest cover. So for the debt to equity ratio, we have said this is a long-term debt or the shareholders' equity. So you go back to the question, you look at what is the long-term debt? It is 800,000. What is shareholders' equity? It is 1.2. And therefore, the debt to equity ratio will be 800,000. You divide by, no, it is 80 million. You divide by 12 million, which is 0.67. The other one is debt ratio, which is long-term debt plus current liabilities. You divide by total asset. So again, if you go back to the question, you'll find that we had the long-term debts, which is 80 million, current liability, which is 3 million, and then the total asset is 25 million, and this gives you 0.44. Then for the interest cover, we have, this is EBIT, you divide by interest expense, which is 4.5 million, you divide by 600,000, which is give you 7.5. So then we have the significance of the ratios. Basically, this is the debt to equity ratio. It measures the balance between debt and equity financing. Then you have the debt ratio, indicate the proportion of asset financed by the debt. Then you have the interest cover, which shows the company ability to cover the interest cost from the earnings. So that marks the end. So each subtopic have a class activity which I will encourage us to try so that you can know whether you have understood the concept. And in the event that you find some challenges, even at an individual capacity, you can side chat me and we can always pick up the conversation and see how we can get over it. Otherwise, unless anyone has a question, we have come to the end of our today's discussion. Any question?
Can you please kindly show us the class activity, the assignment?
So you can see my slide.
No, we can't.
You can see the slide. Let me just
It's on.
Let me show you where it is. So this is the screen. This is the first one. You can see it, class activity. Can you see it?
I want the class assignment.
Yeah, this is the assignment. It's only that I have called it activity, but it's assignment. Just name it assignment. That is the assignment. So this assignment has 3 questions, which will be done individually. So there's that one there. Then there's this second here, assignment, the second one. Then there is the third one. So this is an assignment. And this is an assignment. So these questions will be done individually, and once done, you share where you can. I'll share my email where you'll be able to share the answers for the workings. So and this is done. We're actually doing the same with the physical class. So please ensure that you do the assignment so that I can have your marks. Is that okay? I'll be sharing this note with us. Sorry? Somebody with a question?
Can you kindly share the slides, the group?
No, I'm sharing the slide in the group.
Okay, thank you.
So this unit calls for us to really do a lot of practice, because it's not that it is hard, but it requires a bit of practice for us to get the concept. But I'm very much available for all of us in the event that you feel stuck. I'm much available to help.